Go.
I like to think that.
And well, we're going to maintain that story unless anyone asks.
But you're from Wall Street, so why should we believe that?
The dean has already accused this crisis of my playing a role in this crisis, and now I'm just coming here to talk about what I created. So with that, we have an interesting presentation today for all of you. We really do encourage participation. I'm going to just take a brief moment to go through a couple of slides to try to set the backdrop for this, and then we'll get into the heart of our presentation, and Steve will take over for a few minutes after that. So if you could have this, why don't we take the next slide, please? Recent developments. There are a lot of ways that we got here, but let's take the more recent history that I think that all of us know something about. We had big commercial investment banks started showing loss in credit in third quarter of last year. Mine happened to be one of them. I worked at Morgan Stanley. I remember it very well. We thought that somehow our traders had done something that was different from traders in other banks, and our first reaction was, how did they possibly let the people in our institution do this to us? And yet, as the events unfolded, it became very clear that this is something a lot more ecumenical. And it started hitting banks across the street, and the problem was a lot wider spread. And at the core of a lot of this was something called CDOs. A lot of people come up to me and say, what's a CDO? And it's a very complicated instrument, but I thought we could at least click on this Wall Street Journal link here. You might have to, yep, which will give us some helpful insight into what it is, but you can see it's animated, which helps to begin with. If you just maximize that. And essentially what you've got here, you've got this residential mortgage-backed security trust, and it's got a bunch of different assets in it. Over here on the left is something that really doesn't play too much of a role in this particular slide, but it gives the various credit ratings. But if you can mouse over some of these over there, like the double B plus, you can see probability of 1 year default, probability of that is only 3%. Mouse over the AAA over on the far left. Probability of default over there was 0.061. And then mouse over maybe the trip C or something like that down there on the reds. As you can see, once we go down the credit scale, the probability of these things going belly up increases. And it used to be in the world that what they would do is they would sell to you, or investors, they would sell to you a tranche of AAA securities, residential mortgage-backed securities, or single B or whatever. You got what you paid for, and you knew the sort of class of borrowers that you had. It's hit step 2. Then what happened was we took a bunch of the subprime mortgages, and the subprime, we're really talking about this strip. You had the residential mortgage-backed securities, you had this whole stack of credit quality coming in through here. And again, there are many variations on this. This is just the most simple variation just to get you into the proper mindset. And next slide. And we took a bunch of these MBSs, and we sliced out these trip B levels of them, and we put them all together in this one big pile over here. And then next step, we took that big pile of assets, and then we created and separated out the liabilities associated with those. It'd be as if I took this part of the room and said, over here, you guys all bought the first, we had maybe 30 mortgages in there. You guys bought the first 30 to default, or first 3 to default. You guys bought the next 3 to default. You guys bought the next 3. 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 The people over here that got the last of the mortgages to default, and it didn't matter how they defaulted, what order they came in. Doesn't matter if it was the Abby Jones mortgage or the Bill Brown mortgage. Whatever defaulted first was what this group got. And of course, this group, what they were playing was they were playing a statistical game. They were playing the game that even among this pile of mortgages over here, even though we know they're all trip B, some of these things are going to come to maturity just fine. Some people are going to get all the way down to the very end and pay off their mortgage No problem. The problem was, and that's all good in theory, and but keep now next slide. And you see payments come in, the losses, the payments go to the top, the losses in effect go to the bottom of this whole stack of assets, and then finally, the last slide shows us the way it started out. We rated the top tranches in this AAA because we thought that a lot of these mortgages really should be repaid. The first one, so this group over here got that top stack. Then the next group got the other stack, and finally this group over here got that bottom layer. Now, you guys actually got higher yields off of buying that bottom layer. You got compensated supposedly for that risk. The problem that happened is that it happens from time to time in a statistical world. Things that we think should be normally distributed, you know, everything in the middle is the middle, and then you got a tail over here and a tail over here. Everything went leaning to one side of the bus. Correlations went to 1. And so the things that started causing the bottom layer to go bankrupt or the bottom layer to go into default started making the entire pile go into default until today. This is the current rating mix of one of these tranches. So that's what a CDO in a nutshell looks like. So the next slide on the power, or back to the original slide on the power. Oh no, back there. What went wrong? You know, we talked about what went wrong. Then the way it unfolded, Bear Stearns was taken over by J.P. Morgan in March of 2008. Fannie Mae and Freddie Mac were affected. You had these were the intermediaries for the prime mortgage market. They also intermediated some of the slightly less than prime mortgages. And they also, at urgings of various people in the government, got into the subprime market a little bit. Not a lot, a little bit. They were finally, though, brought into conservatorship within the last month. And interestingly enough, the Friday before they were brought into conservatorship, S&P, independent rating agency for equities, actually upgraded their recommendation on Fannie. Oh, you don't like my microphone. They upgraded their recommendation on Fannie the day before the government took it over, which I thought was really interesting. It's what you call a bad call.
But they're consistent.
They're consistent. They were consistent twice, exactly. Lehman was allowed to fail later on. The government, I think much to the government's surprise, Lehman ended up being in the middle of a bunch of other things called credit default swaps. And credit default swaps, the best way to think about them, don't think about the default term, almost think about calling them credit spread swaps. There's a little more nuance to it than that, but essentially what you're doing is with a credit default swap, you are trading the spread of a particular security over the risk-free security. So for instance, if your security, if the government could borrow at 5% and you could borrow at 7%, your credit default swap roughly would be 200 basis points or 2% difference. And if the credit of that issuer got worse and their regular debt traded out to 800 or 8%, and so 300 basis points over the risk-free rate, your credit default swap would be remarked to market, and you would have actually made money, and it would have traded out to 300 basis points. Now, but just think of credit default swaps as a type of credit risk management that the market over the last 5 or 6 years adopted in great force. In fact, what the market used to do is when they had credit of an institution that they didn't like, they would just simply sell the paper to someone else. And they figured, well, we have too much General Motors paper. Let's sell our General Motors paper. Let's syndicate it out into the market. Let's get it off our books. But what credit default swaps allowed companies to do, it allowed them instead to keep the GM paper on their books and just go buy credit default swaps and overlay it on top of their General Motors risk. When Lehman went into the tank, the credit default swap market got so distorted and got distorted well beyond where credit spread should have gotten. It got distorted because there was a lack of trust in that market altogether. if that market by various measures is somewhere between a 40 and $60 trillion notional market. Now that's notional. That's not the gain and loss that would happen in that market if the whole thing went belly up. But that means that a lot of people who had hedges on all of a sudden were thinking that those hedges may be worthless and that therefore the things that they felt that they'd taken risk out of their books, that risk was popping up once again in their books. So that's credit default swaps. AIG, though, unintended consequences. This government's full of them. Was at the very core of credit default swaps, but was rescued after the government realized how important that market was. And now here we are at the government bailout. So, Steve?
Hey, thank you, Bill. I'm going to try to translate some of that. One of the things that Professor Brown was talking about was how these instruments allocate risk. And a great deal of what is going on is reallocation of risk. Now, we refer to this as a subprime mortgage crisis. I don't think the problem was subprime mortgages per se. The fact that mortgage loans were made to very risky or shaky borrowers, followed a very time-tested model, which is used for credit cards. I'm sure all of you receive credit card offers in the mail all the time, okay? And most of you do not earn an income right now. So why are credit card companies doing this? They're doing this because statistically, they know that some of you are going to fail, but many of you will pay, and they're charging an interest rate that compensates for the failure. And that model, in part, is what was used for the subprime mortgages. There was knowledge that there would be failures, but there was a very high interest rate. In addition to that, with a credit card, there's only one way out, as bankers say, one way for the lender to be repaid, and that is the cash flow. With a mortgage loan, there are two ways. There's the cash flow, and there's the collateral, the house itself. And the lenders felt that the value of the collateral would always be there if the borrowers did not pay. Now, what happened was, as Monty Python puts it, nobody expects the Spanish Inquisition. If you know that one, okay. If you don't, you should watch the old Monty Python episodes. In other words, there are things we simply don't anticipate. And I think the crisis was started by an historically unanticipated depth of fall in housing prices. Now, there are arguments that people should have seen this. There was a liquidity glut. You could borrow money at low interest rates no matter who you were. And this, in part, was driving up the housing prices because the mortgage loan prices were artificially low. So some people saw it, but most did not. When housing prices started to fall at these unanticipated rates, this caused the lower part of the tranches. The tranche is sort of when you issue under a CDO or some of these other securities, basically there are different priorities of debt that are being issued. The highest priority is called the highest priority tranche. That's typically rated by Standard & Poor's, Moody's, and other rating agencies as AAA. You go down to more subordinated tranches, issuances of debt, and those are rated something like BBB, still investment grade. The problem was that when the subprime, loans started defaulting because of the collapse of the housing market, the lower rated securities started to go into default. So you had BBB securities defaulting. Plus, the AAA securities, the highest rated, were downgraded below AAA. Now, this caused a crisis of confidence. People thought AAA meant no risk. And the problem is that AAA does not mean no risk. There can be risk, and people started seeing this. So as people started seeing this, they no longer wanted to invest as readily in the debt markets. And what this caused was basically increase in interest rates. In addition, because there were fewer investors in the debt markets, debt securities lost their market value. And as the value went down, if you basically had borrowed money and pledged these securities as collateral, or had bought these securities, on credit, you had to what's called mark to market. That is, you had to put up more value, more collateral, if you will, to secure the loan that you owed. And this was often done in the form of cash. So where do you get the cash? You sell more securities, and the selling of these additional securities drove the price down further, and so forth, and you became a sort of pricing death spiral. Now, the federal government at that point came to the rescue. And here we have a bit of compartmentalization. The feds, in the form of the Federal Reserve Bank, was the party who traditionally comes to the rescue in these cases. The problem is the Fed's power is basically in response to the Great Depression, where the parties that needed saving were banks and financial institutions. And the Fed's powers under Section 13(3) of the Federal Reserve Act, which gives the Federal Reserve that power. But that focused on institutions, like AIG, like banks. It did not focus on markets, and it completely ignored the phenomenon, which has been going on for the last few decades, called disintermediation, whereby the main source of corporate financing has moved from banks to financial markets. So that the Fed's approach did not really address the core issue of markets. The US Treasury then came in for the first time a few weeks ago with Fannie and Freddie on September 7th, and for the first time they recognized, I think, the market concern where they agreed that if Fannie and Freddie could not sell securities, that they would basically buy the securities to stabilize the markets. And the recent proposal by the Treasury, which is now before Congress, looks to the markets to some extent. It's a bit odd, but basically the government would come in and buy up the securities. Part of the reason is to reduce what's referred to as counterparty risk, the risk that the institutions would fail. Part of the reason, I think, also is to stabilize the markets. So anyway, I'm going to turn this over to Professor Cox.
No, go ahead.
You sure?
Yeah.
Well, I just want to deal with just a historical analogy here, is that most of the financial disasters that have occurred in my lifetime, and there have been a few of them, nothing that rivals this one, that you find that the government takes a situation and makes it worse. Now, I just want to point out a few of those situations, not for blame placing, but for just put in historical context. The first situation was that interest rates were kept at an artificially low rate for a long period of time. We know that even in the I think it was in 2004, 2005, the chairman of the Fed, Alan Greenspan, remarked on a number of times that there was a housing bubble. We also know that during that period of time that the engine that was driving the American economy, which was slowing down otherwise in other areas, sectors, because of a lot of global forces, the engine was driving was home sales. And we also know that beginning about 2005, late 2005, that there was a significant jump in the percentage of all mortgages that were granted that qualified in the subprime category in terms of the number of points that are used by the FDIC to rate these things. It went from something like 7% up to 26% in 1 year's time. And then a number of states became concerned, and leading of those states was North Carolina, Nevada, Florida, and California, enacted through their state regulatory, either legislature in some cases, or broad enabling authority for financial regulations in their states, rules that were going to greatly curtail predatory lending. And those efforts were snuffed out by a regulation adopted by the controller of the currency that essentially in late 2006 prevented the states from trying to retard the rapid expansion of subprime mortgages. So that was a situation was not great. In my own field, in April 2004, the United States government was coming under pressure from the European Union because we had, unlike what happens in Europe, we had no method for overseeing the risks of financial enterprises outside of banks. And the historical separation that goes back to the Great Depression between real banks and investment banks, or underwriting on one side and depository institutions on the other side, was ended with the Gramm-Leach-Bliley Act in 1999, which you then allowed these great, huge operations such as Citicorp to be created, which has an insurance company, an investment bank, a commercial bank, and a lot of other acting credit cards along with it. The EU was pressing on the U.S. to do something about risk management, and so there was discussion. It's really, you can actually find this on the SEC's website and hear the audio of it, about what would do, and they thought, well, it's really outside our skill package, our toolkit, to be able to evaluate the risks of borrowing it on the part of the holding company of an investment banking firm. So what we're going to do, we're going to buy into the idea there'll be self-policing, that the market will have its own check. And that self-policing is going through algorithms and governance structures within the organization to engage in a process called risk to market and police yourself. So the SEC satisfies, and the federal government satisfies the EU's concern that we're looking at this, and so that when the inspectors come in to overlook the investment banking operations and the risks by the SEC takes a look and says, our deposit accounts for your customers who are, have accounts there with stocks and bonds and money market funds, and are they sufficiently protected and walled off? And the answer is yes. And do you have a risk to management policy and practice in place? Yes, we do. Check both those boxes and you move down the street. Unfortunately, the market was not a very good disciplining force. There's absolute moral hazard here. If you borrow, which Lehman Brothers, their capital debt to equity ratio was 32-1. It meant 3% of the total assets at risk in the firm were provided by owners, and the other 97% was borrowed money. And everybody knew that. We knew that that ratio was going up. And same thing with Merrill Lynch, by the way. But the way you made money was borrowing more, and trading more. And if you made a lot of money in 1 year, you got a huge bonus and walked away with it. And I'm about through. And if it failed, remember, you had your bonus, okay? And so you can just retire in the Hamptons and work on your golf game or pinochle, whatever your preference would be. And then the final point I'll say is the bonus mentality has not left. Look closely at the deal with Lehman Brothers. They're buying the American operations of Lehman Brothers, and the purchase price is, chump money on Wall Street. But part of the deal is that $2.5 billion has been set aside for the purchase price to award the bonuses to keep the personnel, because these are personal service organizations. These are not smokestack industries where you make money on capital assets. You make it on skills that are brought to Wall Street. And so even in the demise of Lehman, we still have the ongoing rewards that are fairly significant, I would say, for the problems that many of these people have brought on the firm itself.
Thank you, Jim. Just to take this a little bit further and elaborate on some of the points that both Professor Cox and Professor Schwarcz have made, is Wall Street 15 years ago was a series of oligopolies. Wall Street had some banks that were known as equity houses. It had some banks that were known as fixed income houses. Some were better investment banks than others. But for the most part, they were all oligopolies. We had this big phenomenon happen that injected a lot of cash into the economy, and the cash was actually injected through a couple of mechanisms. Not only was the Fed there and some of the central banks there injecting cash, but more importantly, the markets were injecting cash themselves. And in addition, the sovereign wealth funds were injecting cash themselves. To size the sovereign wealth funds, you have to understand that sovereign wealth funds have at this point both sovereign wealth funds. These are funds held by government entities such as China, the states, the oil exporting states, and others that have current account surpluses. These sovereign wealth funds approach somewhere the 12 to 15 trillion dollar range if you include both reserve assets as well as the reserve fund assets. Very big numbers. In turn, these sovereign wealth funds were indiscriminately, as Bill Gross from PEMCO said, they were the price-insensitive bid for fixed income securities. They had no other place to put their money but fixed income securities. They bought it every day. $2 billion every day had to be bought by these people in the market to deal with the problem. So this flush of liquidity that came into the market is really a function of the current account imbalances, and until and unless you fix that, the flush of liquidity will continue to be generated. This allowed the investment banks and the commercial banks to borrow at incredibly low spreads. That meant that these banks that were satisfied with having 2 or 3 operations decided that they wanted to get into everyone's business. They could borrow at 25 basis points over government borrowing costs, and so the old oligopolies broke down, and the banks got into each other's businesses like crazy. And they expanded like crazy. Wall Street today, the amount of employees on Wall Street today is over twice what it was just 14 years ago. So we've got these problems, and now we're at the point where the spreads have widened back out to 1990 levels, and we've got a financial services industry that is way too big to fit in its shoes that it's created.
Okay. I assume we're talking about the how bad is it part now?
Yeah, we can, yes.
Okay, or,
yes.
now, topic basically, and this is something that Professor Brown has been discussing, is how bad is it? Certainly a lot of people are going to lose their jobs in the financial services industry. I'm not qualified to really express a view as to how bad it is. Potentially it could be very bad. I mean, potentially it could be as bad as the Great Depression. But I will make some comments on why there is so much urgency this week. Certainly, one reason is the wake-up call of Lehman's failure and AIG, basically, the bailout. There also was the flight of money to very safe means of investment, such as Treasury bills. Even money markets were not regarded as safe enough. Some of the urgency may reflect inside knowledge that other financial institutions beyond AIG and Lehman are in imminent danger of failing. And some may also reflect concern about a possible chain of defaults on the credit default swaps, the CDS, which Professor Brown has talked about. An easier way of thinking about them is basically guarantees made by financial institutions to other financial institutions for a fee. And that's essentially what they are. It's like insurance, basically, and everyone self-insured each other. The theory of the CDS, or at least the positive purpose of CDS, was to try to reallocate risk throughout the financial system, but it also has the potential to make risk more systemic because a failure by any given entity could trigger failures down the line. More cynically, some of the urgency this week could be the Bush administration's using fear to try to push through a rescue package to try to say, look, we solved the problem happened, but we solved it on our watch. And I'm not sure, whether all those reasons or none of those reasons are the real reasons. But there is, I will note, a very self-created urgency, and that is with the government officials announcing that we must reach a solution this week or soon. The failure to reach a solution is going to completely spook the markets and is going to exacerbate the panic. Jim.
Well, and, on the front page of the News and Observer today, there are actually two things to read in the News and Observer today. One was on the front page was to say that Durham and Raleigh each enjoy a AAA municipal bond rating, and each of them have had to pull offerings off the market because they reissue a string of debt, small amount actually, and there were no bidders, period. So that's an indication that this thing is trickling down into the reaches of localities. The other part that you should read in the paper is our own Andrew Foster, who is the director of our clinics here, has a very thoughtful op-ed piece in the News and Observer pointing out that the need for a broad approach to addressing these issues. And it really is worded very, very, not provocative, but just thoughtful. And we're taking a look at. And, it could be, I just want to double back to something I could have said earlier. It could be that the problems that we're having with the AAA rated bonds is, for Durham and Raleigh is nobody believes the ratings anymore. Because my flip remark earlier was more than flip, I think it was pretty accurate. They're consistent, consistently bad. There's a big dispute about the role that rating agencies play and whether we even ought to have them. But we defer a lot to them. There's an interesting study. I mean, people's eyes gloss over when you see that and think about that's all that academics talk about. But an interesting study about comparing the frequency of downgrades for different types of financial instruments, downgrades being like from AA to BBB, et cetera, depending upon the arrangement by which these financial instruments have historically with the rating agency. That is, if the rating agency, if these are ratings in which rating agencies are competing among themselves to provide a rating, and they provide that rating and it gets paid for, then what you find is that the number of downgrades for that type of situation, when they're kind of sort of like selling their good housekeeping seal of approval, is about 10 times what you find in the situation in which the rating agency is more neutrally involved and comes in not at the request of the person who's generating this product, but comes in at the request of somebody else, okay? So a fairly profound documentation that ratings on many of these instruments are purchased, not conferred, okay? With a different thing, or earned for that matter. So that could be a problem with the rating agencies. It's unfortunate when Congress was looking at this. This is not the first time we had problems with rating agencies. Remember that, was it Standard & Poor's, Steve, or Moody's that downgraded Enron 3 days
Both.
after it? From both of them.
Well, like a day or two before it went bankrupt.
Before it went bankrupt. I mean, that's sort of, hello. A lot of things were happening right there. Everybody knew it was going to go bankrupt. Just a question about which minute of that day was going to happen, and which court it was going to be, whether it be New York or Delaware. The agency, there was the furor about that, and then the financial organizations come to town, as they frequently do. That's the difference between the 33 Act and the 34 Act. When you teach securities law, you learn about the history of those. It come to town, and at the end of the day, instead of really introducing meaningful authority over the rating agencies, it was just a sort of a disclosure regime that's filled with milquetoast. And it'll be interesting to see what comes out of this process, but my guess is that not much again. So.
Can I respond on the rating agencies? I agree with some of what Professor Cox says. I disagree with other parts. Let me give some background. Rating agencies, they're private companies, basically. They make their business based on their reputation. Their rating is a rating as to the likelihood of prompt and timely payment on debt securities. Biggest ones, Standard & Poor's, Moody's, Fitch, and there are some others much, much smaller. There are problems with rating agencies because they're run by human beings, and we're all imperfect. And I'm not aware of any fraud of any sort, and I don't think that ratings are purchased in that sense. But ratings, you know, ratings, first of all, are not based upon fraud. A rating agency simply accepts information that is given to it by the issuer of securities and does not go beyond the information. Okay, so that if a company, let's take Enron, is engaging in fraud, the rating agency could not really ferret that out. Now, you may ask, should rating agencies check fraud? And that's a separate issue. But at least heretofore, they've not. Congress has, I've testified in rating agencies before Congress and before the SEC, and I know that Congress has concerns about the inherent conflict of interest in who pays the rating agency. It's paid by the issuer of the securities. And that's a conflict of interest, there's no question about it. But what are the other ways to do it? You could have the investors pay the rating agency, in which case, rather than having a desire to have a high rating, which the issuer would want to get a low interest rate on its debt, the investors who want a low rating, basically, to get a high interest rate on their debt. So that would create opposite incentives. You could have, I like to think of rating agencies in terms of wine. I like to think of everything in terms of wine, but that's a different issue. Robert Parker is a former lawyer who writes The Wine Advocate, which is the leading, basically, wine rating agency, if you will. He rates wines. And he advertises, he says, I do not let any maker of wine pay me. And that is the most pristine way to go. And in fact, about 100 years ago, Moody's and Standard & Poor's were paid that way by subscriptions. The problem is you have all these analysts who are very sophisticated, and you can't generate as much fees as you need by magazine subscriptions. So it is a problem. They're not perfect. They should be subject to severe scrutiny, but I do at least think that they remain and will remain a public good.
See, I actually think that, that it really doesn't matter who pays them. It matters the quantity that they actually have to rate. And if some issuer is issuing a huge quantity of debt, the rating agencies do well. And only if the rating agencies rate well is that issuer able to issue a huge quantity of product. So it's not a, I think the payments really a red herring here. And yes, does the issuer pay them? Yes, but it really pays them by returning their favor of a high rating by issuing more and more product. And the rating agencies too, they're not doe-eyed in the woods. Every time we've had a crisis, it is because of something existing in what we would call fat tails. LTCM was about the problem that you had outlier events. LTCM was about the fact that you had a confluence of events that made correlations of otherwise uncorrelated assets shoot to one. The 1987 crash, same thing. Our markets are structured in such a way, and you know the people in my class have read the book Staber book on this, that they end up finding these moments where there's this confluence of everything going to one side of the bus, and the bus turns over. And the rating agencies simply have to understand that that's what can bring the market to its knees, and they don't take that in there.
One thing I just want to point out just more generally, and that is that since it's law school, we ought to pay attention to things, the sort of intersection of economics, for example, and law, is, as Steve was pointing out, so much of the industry, in fact, so much of the financial services industry is characterized by poor structure, that is, there are oligopolies. Whether you're talking about investment banking, which is what your analogy was, the accounting profession, where the Final Four audit all the Fortune 500. They audit 97% of the productive assets of America. You know, these are the big four accounting firms. The rating agencies, what was the hope behind the rating agency legislation that came out after Enron? It was the idea to make this less a monopoly so that they would compete. Because they were not competing, there was a lot of parallelism. They didn't compete on price. and they were secure in their reputations because you only had 3. So the idea is that maybe they would be, and therefore they didn't compete on quality either. They were just out there. And so the idea is that hopefully with making it, removing the block that the 3 had, that you would then get some competition, certainly on quality. So the structure of the industry has a lot to say with how well it performs, and much of our financial markets are not performing very well because they're characterized by oligopolistic structures at almost every level.
Now, what I think we should do at this point is talk about the appropriate fixes, if we can. And Jim, do you want to start us off on that?
Yeah, I'd be glad to. You know, I actually think that the bailout that's being proposed right now is to get this, bubble or embolism, as the case would be, that's blocking the flow of cash out of the financial institutions so as it moves forward. I mean, I think that's appropriate, but I think it's inappropriate to think about that as the only solution. That I think we ought to think that this problem has been, I believe, seriously contributed to, if not created, by what's happening in home mortgage foreclosures. The large number of foreclosures are yet to come on. The subprime adjustable rate mortgages that were issued in the last few years start showing their ugly heads, being readjusted to very high rates in 2009, 2010. That's what all the data is. So we're in for a world of pain there, and we need to have something to because that's going to be the, that's going to be the tsunami. It's gigantic. So we need to be doing something. And there've been a lot of proposals early on, but it seems not to be part of the discussions ongoing. And just a couple other items. Obviously, transparency and accountability is important. We don't want to have these matters occurring. We had, in the Great Depression, a financial czar that was actually handing out money to business enterprise through the Reconstruction Finance Corporation. But there are high level of oversight, accountability for that, and it was overseen by an individual who believed in transparency and was really tough. A guy's name was Jesse Jones, as a matter of fact, and he had the temperament of Jesse James, quite frankly. But you need to have bipartisan oversight. You need to have independent people who are going to be handing out this money. And I actually think that what we ought to be doing this is in stages. I mean, instead of just talking about here's $700 billion to spin it up right now, that we ought to think about a series of authorizations that would go down and sort of do something now and then set the clock so the new Congress comes back. And if you did it in stages, that's the one way of sort of policing what happens on the early front of the deal. So it'd be interesting to see what's going to happen. I would imagine that something will be inked this weekend because nobody wants to be alleged to have derailed a train that was going to rescue America's fortunes. So, and this is an election year. But hopefully there'll be checks and balances along the way. And hopefully it'll go after several things, not just dealing with the trash that's on the books of the financial institutions, but it goes to some of the root causes of this, which is allaying the concerns that I have about what happens in 2009 and 2010 with foreclosures.
Steve?
Okay. Well, I agree with much of what Jim says, all of what Jim says, but I would add some things. First of all, whatever we come up with, I think we want to think beyond the subprime crisis. I mean, there are things you can do that would be geared to the crisis, for the future. In the Great Depression, there were a number of fixes. One of the main fixes was imposing what's called the margin regulations. These are regulations G, U, and T and X, and these regulations basically say that when banks or others make loans, you need to have collateral coverage twice the value of the loan. Now, if we had something like that, of course, with subprime mortgages or mortgage loans, we wouldn't have any defaults right now, because even if home prices dropped by, in half, there would still be enough collateral coverage. The problem with that type of solution, of course, is it makes credit very expensive. And so we need to sort of try to balance solutions that impose costs with solutions that are sensible. I think that any fundamental solutions must really focus on the markets. What we need to do is to restore market confidence. Because once we have market confidence, the credit markets will reopen, mortgage money will become available at lower rates, home prices will stabilize and begin rising. And then the problems with the ARMs, adjustable rate mortgages, dissipate. Now, the problem is how to raise these market prices. And Professor Cox has talked about making things more transparent, and ideally that's absolutely correct. One problem is that the securities in the markets have become so complex. I'm sure every one of you understood the CDO illustration up there. And CDOs, collateralized debt obligations, are by no means the most complex instruments. You get the ABS CDOs and, CDOs squared and cubed and everything else. So disclosure itself is troublesome. Many of these disclosure documents or prospectuses go to 500 pages, and it's really hard to understand them, even for someone who ought to understand them. The markets do need government intervention. We all believe that markets left alone will function perfectly, but the problem is that when you have imperfect disclosure, you don't know what you're investing in. And so investors are very loath to do that. Plus, there's a certain herd behavior. There's also the problem that investors, institutional investors, basically invest with the intention of reselling the securities. And where you have a market that is falling in market price, even if you think the intrinsic value of the securities is higher than the market value, you're not going to buy because you won't be able to resell within some period of time. So I think we need, as the Treasury is now proposing, some sort of government to act as some sort of market liquidity provider, basically to stabilize prices and to take the bad stuff out of the institutions. See, I have other thoughts, but I don't want to keep you too long, so let me just go through some. I think we need some specific fixes too. I mentioned marking to market, which creates a downward death spiral. We may need to re-examine that. That's an accounting concept in part. But we don't want to over-regulate the markets or micromanage them because, as Professor Cox says, government does have a tendency to over-regulate, and when it begins regulating, it never stops. So one thing we need to do is really think about this, and I think we really need to have people work with government who understand the markets, scholars, people experienced in how these markets work, like Professor Brown, to really give guidance to Congress, because unless we have that real-life guidance, we could continue to have basically bad solutions.
Did you have a couple?
The transparency I was talking about is how the government hands out this money, not about the instruments.
I agree with that.
Yeah,
yes.
thank you.
Sorry.
As far as the fixes are concerned, can you throw up the very last slide that I have? The very last one. Last one in the stack, all the way down. Down.
We're from here?
No, this slide that says Fannie Freddie plan not believed by markets.
Yep.
Keep going. There you go. This was when the government, this is the spread of Fannie's debt over government debt right when the government announced their plan. And as a result, their spreads, the plan was announced, their spread came down, so the government said, listen, we don't want Fannie and Freddie borrowing at this high rate, because if we're giving them implicit guarantees, they really should be borrowing at much better rates, because otherwise we're going to end up paying the bill, and we should pay as low a bill as possible. As you can see, the market hasn't really believed that the government's going to do what it's doing, because the spreads sort of have gone back to where they were right immediately before that. I share Steve's belief that we really do need to stabilize the markets, and the mechanism by which we do that, I'm a bit cynical in the ability to simply by moving a bunch of traders from Wall Street to Washington, D.C., that they'll be able to do anything better in D.C. than they were able to do when they got us into this mess in the first place. The other alternative is that the government would just simply buy these assets. We don't know, by the way, how they'll buy them or how they propose to buy them, and just buy and hold, at which point you'll have this perennial overhang on the market that will also artificially reduce the prices because people will know what assets the government's holding and that they have to, sell out. So the mechanism of actually getting too heavily into this is somewhat concerns me, because I am a bit of a libertarian in the amount of government involvement in things, and I do think that there are ways to facilitate a market solution where the government can partner with the market rather than the government taking a heavy hand. The other problem that I have here with our current situation is that it happened almost imperceptibly, but we got rid of the FDR-led restrictions very slowly over time, and quite frankly, one of those actually led to the S&L crisis, because it liberalized what S&Ls could actually invest in. And once you allow people to invest in things that they think can make more money, they tend to invest in things that can make more money, and they invest in things that they don't know anything about, and they get in trouble, and they lose a lot of money, and we pay the bill. So I would actually urge rolling back the clock on some of the deregulation that we've seen. I'm not a huge fan of regulation, being the libertarian I am, but still I think that what we had with the FDR structure was helpful. I think part of where we've gotten, though, is more because of the complex overlapping of regulatory structures that we do have. We have for banks, you have the SEC, you have the Fed, you have the OCC, you've got the Office of Thrift Supervision, you've got the Office of Credit Union. It just keeps going on, and the fact is there's not a single good regulatory agency out there. Even looking at the Fed, though, assuming that the Fed is in great shape to regulate banks, I think that their expertise on that really should be brought into question, because if you look at how well those commercial banks have done that did morph into investment banks, with the exception of J.P. Morgan, which is an American bank, and HSBC, which isn't, all the other sort of combined investment bank commercial banks have performed abysmally. And this has been on the Fed's watch. So we can't assume that the Fed's going to be doing all the right things here, and so I think the regulatory framework definitely needs help. I think it does need streamlining, and that possibly can be one of the real silver linings from all this, is that this might be the time that we get rid of all these initials and acronyms and create a more consistent regulatory framework than we have. So with that.
Well, let me just add, in terms of the pricing, one of the central issues is pricing. If the government's going to come in, how do you decide how much to pay for these securities? And I've been working sort of with some people on that. There are a couple of approaches, and whether it will ultimately end up in legislation, I don't know. But there are two types of securities in question. And one type, or it's not really a type, but sort of if you sort of put in different categories, you get this. Many of these securities that are so-called toxic actually have a very high intrinsic value. If you were to look at the expected value of their cash flows, that is, what the cash flows are likely to be generated over the maturity of the securities, and present value them, you'd come up with a pretty high number, a number that is significantly higher than the market value of those securities would reveal. And so in those cases, if you have some assurance, and you're never going to price it exactly, because trying to decide what the expected value is means you have to know which mortgagors are going to default, and you can't know that. But you can get some sense, and for those securities, you may be able to buy them at a deep discount and still buy them at a price that enables the institution you bought them from not to suffer an accounting loss, and at a price that enables the buyer, the government, to ultimately, if it holds them to maturity or if the markets turn up, to make a profit. Now, other types of securities you may not be as sure about. And in those cases, there are mechanisms to purchase. And what's ironic is those mechanisms sort of arose from the very types of mortgage-backed securities that were created here. And they basically key into a very obscure provision of financial accounting standard FAS 140. And this allows pricing of financial assets that are almost impossible to price based on very vague terms. And whether that's how it will come out, I don't know, but I'm simply saying that there are potential solutions.
Thank you very much. Now, what I'd like to do is we'd like to open this up to questions from all of you. And I don't know how you guys want to handle this, if you want to turn on the mics in the room or the mics in the room are turned on, so please, if you have any questions.
So it sounds like a lot of this is psychological, and I'm wondering if there's any possibility that too small an infusion of cash or too small a solution, a buying of assets, might actually just be evaporated by continued panic. Is that a possibility?
Yes?
Yes.
You talked about Glass-Steagall that separated commercial from investment banking, and we see now, after the repeal in the 90s and then recently the reclassification of these investment banks to commercial banks, we seem to be going back to where we're commingling. This is back to, I think, what Professor Cox was saying, that perhaps it's the problems with unintended consequences, but at the same time, the government's going to have a lot of control over that. And I'm concerned about bringing the commercial banks in under the umbrella of the investment bankers, because they're just going to use those deposits to loan them out. Do you see that a good move or a bad move?
I think it's a very bad move that they're pulling it back in for various reasons. And unintended consequences is one of the big ones. Let's face it, I mean, FDR, I mean, it's wonderful to read his inauguration address where he refers to money changers and nasty people and stuff like that. He was pretty clear in his view that it was this unfettered risk-taking that was causing problems. And one of his primary goals was obviously to put everything on a firm footing, but his primary goal was to make sure that the banks were on firm footing and that the banking system worked. The more that you allow risk-taking to insinuate itself into the banking system, the more that you make that problematic. Now, you might argue that the two have morphed together in terms of product, but I think that let's take what will happen with Goldman and Morgan Stanley. Goldman and Morgan Stanley have, as Professor Cox mentioned, their leverage is very high compared to the commercial banks, and so for them to compete with the commercial banks and have the same sort of characteristics as commercial banks, they need to do several things. One, raise capital, which they've just done. Morgan Stanley raised money from Mitsubishi UFJ. Goldman Sachs raised it from Buffett. You have, they're going out looking for deposits. But now the other shoe that's going to drop is this. They've got a lot of assets that are right now no longer relevant to their current modus operandi. Those assets ultimately will be going on the market and will be depressing the markets here. So I don't know what those unintended consequences will be, but I think we've gone down the Glass-Steagall breakdown road one step too many.
As far as I know, the current financial crisis not only influenced the United States market, but also actually spread out to other countries. So I'm wondering, are there any international cooperation to solve this financial issue, or just up to now, all other governments or central banks of other countries just majorly relied on the United States to solve this issue?
Well, I think that the U.S. has been in I know that the U.S. has been in discussions with other financial, central banks for over a year now. Last November, here at Duke, we had a colloquium on systemic risk in the financial system. It was very well timed, and we had representatives of a number of central banks. They're all very concerned Bank of England, European Central Bank, Asian central banks. So they are working with the U.S.
I just got back a week ago from a week in Hong Kong, and I was interesting sort of talking to people there from a lot of different countries that they're blaming the collapse, which has been substantial compared to ours, of their capital markets on our credit crunch. And when you penetrate that, what it really means is that we're all going to Walmart a lot less and buying things that and so the demand for the products is way down. But they also, as Steve pointed out earlier, have been great consumers of fixed rate securities, and so they own a lot of this junk, and they're sovereign funds, but even less so than here. They're not very transparent about how much of this stuff they're sitting on, but they're sitting on a lot of it.
If you pull up slide 3, you can just graphically see this. This is just a rolling total of the carnage. On the top, on a regional basis, you can see third quarter of 07, fourth quarter of 07, first, and the red numbers are the losses that they've reported. The green numbers are the capital that they've been able to raise. The third quarter numbers are really still coming in, so view the third quarter as to be determined. But if you look over here on the total, the Americas have 263 of losses, and this is a lot larger than this. This is just what's been formally reported. The Americas have 263 of losses, Europe has 232, and Asia only 23. So that seems to be the latest breakdown, a lot of this. And you can see the first part of the hit parade down below, Citigroup, Merrill, UBS, big problem, UBS. HSBC, as big of the number it is, it's a much bigger corporation. Wachovia, for its size, is very large. Deutsche, and then on down the line.
Yeah.
Do you want to point out, or should we just? Yes.
I had a question about the SEC's short selling rules, the new interim rules that they put into effect last week. I want to know what are the intended consequences of the short selling rules, and are those rules going to artificially keep prices higher than they should be?
Well, I'm not a great supporter of those rules, and the intended consequences are to remove downward pressure on financial stocks. And prophylactically, I think they were supposed to act as well to remove the incentives for people to spread false rumors in the marketplace so as to capitalize by selling the company shares short. There was a paper again out in the SSRN that looked at the SEC's first foray into this and found that in a matched sample situation that as best they could see that this decision to suspend short selling increased the risks of those stocks and drove the values down something like $63 billion for the 217 stocks or whatever it was that was in this group. And so I think it's very problematic. And people engage in short selling as a way of hedging against a swap transaction they may have engaged in or a call option that they're on the other side of. And so I'm completely mystified about this rule, but it's there.
I know that Professor Schwartz is focusing on complexity, and some of you have read the Bookstaber book on complexity. Also, this is a great illustration of where complexity of regulation layered on top of complex situations actually produces unexpected results.
Also, the data is very questionable. When you look at the stocks that have taken a beating before the demise of the firm, the short selling was about 2.5% of the trading. I mean, real sales were driving things. It wasn't the shorts that were putting pressure on it.
Do you think that they should have the uptick rule come back or not?
Do I think what?
Do you think they should bring the uptick rule back?
That's a good question. All the data in a normal market, and part of it was on a person who just recently minted PhD. It was one of those studies, all indicated that the uptick rule had no effect on the volatility of stocks. And so this is the rule that said that you cannot sell a stock short unless the trade prior to you, the stock was moving up one tick. And the SEC had that rule historically forever, then relaxed it for a sample group for a number of years so people could do the studies. And they found that it had no effect upon the groups of stocks where the SEC's banned it. So I don't think the uptick rule will come back, no.
Yes.
Steve? Oh, we got, well, thank you all very much.
I got a pair of glasses. Well done, well done.